All right, so today and this week has been a very busy week. I had hoped to have today be about, hey, how I came to creating the life of my dreams and telling you all of my career hacks and all of that, but the world got in the way. So this week, the US public debt soared to $40 trillion. Today, the Dow Jones Industrial Average lost 700 points. That's over 1%. Now, that's not a lot because the stocks are still very close to an all-time high. But these are signals, and they're signals that we've been warning about for a while. And what is that signal? It is that the US debt is on a path to keep increasing. And because that's the case, even though the US debt, the US treasuries are worldwide desirable, people always think, oh, that's a safe way to earn a good competitive market yield. It's the safest treasury in the world. And yet, as our debt rises, they're starting to say, well, come on, guys, you can't just keep borrowing and borrowing and borrowing and running everything into the red. So let me show you what I am talking about and how we can put it into context. So the first thing is this. Here's the blog on it too, so that you can get additional information and go deeper on everything that I'm talking about. The US public debt is 40 trillion. The budget deficit this year is expected to be 2.1 trillion. The interest on debt is 1 trillion, and that's 3 times what it was in 2020. And the total US debt and loans for all sectors is 100 and almost 116 trillion. So it's really even a lot more than what you're hearing about because most of us are just hearing about the public debt. So again, the main theme that we want to talk about is what does this mean for you? And what do you need to do to protect yourself from it? So I'm going to talk about a lot of different things, but I want to give you the cliff notes first of all, is that the safe side of our portfolio is dangerous. So in 2022, stocks lost about 19.44% in the S&P 500. Long-term government bonds lost 26%, and they have not recovered. So as interest rates go up, that's interest rate risk. But we have been dealing with duration risk and credit risk for a very long time, honestly. About half of the US debt is at the lowest rung of investment grade. That is credit risk, right? And then what's been happening is that they've just been making the duration longer. And the longer it takes people to pay you back your money, the more risk there is that they aren't going to be able to do that. So all of these things are present now in the bond side, which is what traditionally and what a lot of money managers will traditionally think of as safe. And that's why it is important for us to be the boss of our money, to know exactly what we own, not just on the at-risk side, what the funds we have, and make sure we have that age-appropriate plan. What do we have on the safe side? So just to let you know as well, in addition to spending one day on this topic at the Financial Freedom Retreat, and honestly, what's hot and what's safe changes every year. So if you attended a retreat a year ago, it's different today. And the things that I think are our best opportunities are different today than they were a year ago. So we are hosting also, in addition to the Financial Freedom Retreat, we're hosting a bond masterclass. This is going to be on November 7th. All right, so the next Financial Freedom Retreat is October 10th through 12th. It's online. And then a couple weeks after that, on a Saturday, November 7th, we're going to host the bond and what's safe, fixed income without paper losses masterclass. So again, let's go ahead and dive in a little bit more to these topics. Increased risk to the economy, will debt keep rising? Will interest rates go up or down, etc.? So the risk to the economy does increase with the rising interest rates. And with inflation sticky, that increases the risk that we have to have rising interest rates, but also the rising interest rates of today are because the worldwide investors are saying, hey, United States, if you don't get your debt in order, we're going to ask for a higher interest in order to give you the money to keep running in the red. So that's what's happening. That has nothing to do with the FOMC policy. This has everything to do with real-time investors. Mainly right now, it's the whales of Wall Street, right? So what'll happen is a lot of the money managers and a lot of people are on holiday in August. In September, when they come back from holiday, they're going to be calling all of their clients and saying, hey, we're going to be doing this, that, or that because of the interest rate risk that is present in the bond market. And that is all usually negative for stocks. Now, you might say, and before we talk about the other things, you might say, oh, well, that should be favorable for gold or silver or crypto, right? And what we saw in 2022, when bonds really took a dive and stocks took a dive as well, is that crypto took a deeper dive. And so did, by the way, the Magnificent Seven. So the biggest losers of 2022, the S&P was down 19.44, the NASDAQ was down about a third, and things like Tesla and Bitcoin were down two-thirds, minus 67%. Even Nvidia, a lot of the Magnificent Seven was down about 50%, and Tesla was one of the worst ones at 67%. So um, crypto has headwinds, even though, yes, when people get worried about the safe side or they get worried about the dollar, they are more interested in cryptocurrency. They are more interested in perceived safe havens. Safe havens are very volatile. So I don't just say dump all your money there, but a hot slice or two is good. I would say silver rather than gold or crypto, although it would be in order, it would be silver and gold. So gold was pretty much flat in 2022, and silver had earned a slight amount. So again, Bitcoin was down 67%. The reason for that is that a lot of times the people that are very interested in crypto are also in the stock market or maybe even trading on margin. And that leads me to the retail and the day traders. They actually increase the volatility and the speed of a correction because of the amount that is actually at risk right now. So there's a lot of gambling going on Wall Street. Margin trading is pretty close to an all-time, actually, it is at an all-time high. So that increases the volatility and the speed of which that these corrections can occur. The only time also that we have seen stocks at a higher price was actually in the dot-com recession. And this is what happened then. The NASDAQ lost 78%. It took 15 years to recover. So again, $1 million losing 78% is about worth about $220,000. So again, what we want to do is be age appropriate, properly diversified, and to know what's safe in a debt world. And whether you're going to get that at the retreat or the bond master class or through my private coaching, now is the time to do it, because when Wall Street returns from vacation in September, that is historically the worst performing month. So if you haven't rebalanced recently, now is a good time to do that. So the risks to the economy are rising. The debt is rising. Interest rates are rising. Bond investors are, for the most part, I would say on all of the second opinions that I do, there's usually a lot of risk on the bond side. So a lot of times you're being sold into, some people they're just saying put into a bond fund. And a lot of the bond funds are losing money too, right? So you have to be super careful, even if you have a managed plan, you have to really know what you own, and you have to, if it's a bond fund, I honestly would just not do it. It's definitely not something I would be doing. If it is an individual bond, I would be very select about it. So I do have a blog that I'm linking to in this most recent blog. And that is on it, the title of it gives away the whole premise, why I prefer select being a very, very important word, not just any, select corporate bonds to treasuries. So if you're going to read that, be sure that you read the entire thing and keep that word in bold as part of your analysis that you're doing with the blog. So what about stock investors? So again, if I were, worried about this, first thing is we do have those free web apps where you can personalize your pie chart, make sure it's age appropriate and diversified, and that you don't have too much at risk. We are now at this time, because of all of the elevated risk, which includes rising interest rates, which includes a war, which includes elevated equity prices, and a number of other things, we're overweighting 20% safe. I understand if you're, older than 70, why you might not want to overweight 20%, but you might consider overweighting something at minimum. So I already talked about the retail day traders. I talked about crypto. I talked about gold and silver. So again, I think that your best plan right now is either if you know how to categorize your current plan into an Excel file and put all of the large cap value, all the large cap growth, put them in a slice so that you can actually compare apples to apples with the sample pie chart that you can create with our free web apps, right? The personalized one for your age. Email info@nataliepace.com, or you can also access it on the homepage at nataliepace.com. And that way you are comparing apples to apples. If you have too much large cap growth, sell high, trim it back to where it should be. In terms of how many slices, 10, small, medium, large value and growth, that's 6. And then 4 hots. What would I have in the hots? I think that we have been having a lot of Magnificent Seven. We've been having a lot of cybersecurity. We've been having we've actually been doing value replacements, which I think is super, super important because a lot of these bonds, long-term bonds that are the real problem in the economy, are also the companies that are present in our value equity funds. So we're going outside the United States for our value, and we're getting a competitive yield and lower risk in some of them. So there's a lot of nuance here, but it's all designed to serve you. I probably, again, I'm going to be taking a bigger, deeper dive over the next couple of weeks, but I would say that I'm probably going to be removing the Magnificent Seven from the hot. Not, you're still going to have a lot of it in your large cap growth funds because honestly, most of the large cap growth funds that are United States based are about 60, 70%, at least the ones that we're looking at, the ones that we prefer are 60, 70% Magnificent Seven. So you're still going to have Magnificent Seven in your large cap growth, but that's going to be a big slice if you haven't rebalanced. So you're going to capture gains at an all-time high and still have some. As for that overweight, in an extra hot slice of Magnificent Seven, I would say probably we're going to be removing that. And I would say we're going to probably stick with silver over gold. We did remove cryptocurrency because the crypto winter may extend through 2027 about this time. There are reasons for that. I have a blog about the crypto winter that you can read if you'd like to do that. Medical devices could be interesting because they have been, there's been a pullback on the price, but I would still, if I had a slice that I didn't have, I would be dollar cost averaging into it because of the elevated equity prices. FYI, we help you design this in our private coaching program. And then also, I think that cybersecurity in particular can also be kind of serving the role that utilities used to serve, in that corporations cannot get rid of their cybersecurity. So, they used to say, hey, hold on to utilities as a safe haven in recessions because people pay their electric bills, they pay their water bills. But I would say corporations have to keep paying their cybersecurity bill no matter what. So those are just some previews of coming attractions. But again, we're going to be deep diving into all of this at the retreat itself. And of course, I'm constantly monitoring it as well. So share this with your friends. Remember that, look, I know that people don't like to talk about money, but it is okay to say, hey, if you're wondering what to do about this crazy debt world and wondering what to do about paper losses that you're told not to worry about, that may have more, problem to them than you're being told, that they should be watching this video conference. And again, it's free. You can listen on Substack, you can watch on YouTube. I'm Natalie Pace on both spots. You can forward it to your friends. I strongly encourage you to subscribe to me on both spots because, like today, I just woke up this morning when I saw what was happening, that the investors had rejected the Treasury's bailout of yesterday. I had a suspicion that that might happen, but I didn't know it would happen so fast because in August, they try to do all this financial engineering thinking everybody's on holiday. And sometimes it doesn't happen that fast. So the Wells of Wall Street are really watching this right now. So yeah, whether you want to join us at the retreat or, get private coaching from me and get that unbiased second opinion, I would just say, know what you own right now. Do a pie chart of what you have, do a pie chart of what you should have with our sample web app, and it makes it easy. The slice is too big, sell high and trim it back. That's going to go into your safe allocation, right? A slice you don't have, maybe it's that slice of silver, but go ahead and dollar cost average into it. Again, this isn't about the hot slices as much, although I've given you some things that I think we're going to be adjusting on the hot slice side. I do have a lot of blogs about the value replacements, about what's hot, why we think it's hot, etc. So you can read those in the blogs, or of course you can get updated in our retreats as well. All right, so I think that's it. Basically, know what you own now, rebalance now so that you're capturing gains at an all-time high. Pay a lot of attention on the safe side because you can get a market yield without paper losses. And it's just tricky. It's not difficult, it's tricky. And the list of things that we think you should be considering on the safe side keeps getting longer as the risk gets more elevated. So it is important to stay on top of it and not to just have everything in treasury bills. I wouldn't. I wouldn't have everything in FDIC insured CDs. I wouldn't have everything in one select corporate bond either. And again, when I say select, I mean we are being forensic about what we should select and what we should not select. Yeah, I'm trying to think if there's any other tips that I need to give you. Oh, yes, I did want to tell you one more thing. We have a BOGO sale going on. So when you buy, whether it's an all access pass or a pass to the retreat or a pass to the master class, you have to do it by Sunday. You're going to get a second one free. If you buy one coaching session, you get that second one free. If you buy 4 coaching sessions, you get 4 more free. Now, if you're already a member of our volunteer team, then you're getting better deals than that. You just have to email info@nataliepace.com and ask for your volunteer coaching rate. Okay. Thank you for joining me. I'm going to stop here. I'll see if anybody has any quick questions. And if it's something we all want to know about, then I'll come back and answer it on air. Okay, so I just want to show you on our website a little bit about how you can learn more about the upcoming Bond Masterclass, as well as our blogs and the retreat. So nataliepace.com, the Financial Freedom Retreat, October 10th. If you click on that, it's going to take you right over to the flyer where you can learn more about pricing. Remember, BOGO happens now through Sunday only. Okay, so if you are interested in buy one, get one on the retreat, you got to register before Sunday or by Sunday. You can call us, you can email info@nataliepace.com. Also, if you are interested in the blog or the Bond Masterclass, you got to go into the menu on the upper right, and the Bond Masterclass is right there. Click on that and you go to that flyer. Additionally, if you're interested in one of our blogs, there's the blog there, and the most recent one comes up. I am linking to the blogs that I talked about. I'll also link to one that I forgot to link to, which is the gambling, that Wall Street has a gambling problem in that margin trading aspect. But here's why I prefer select corporate bonds. So in this margin trading one, the retail day traders, I'm also going to be linking to one. Wall Street has a serious gambling problem is another one of the blogs that I want to link to. And then finally, if you're up for an adventure, then we have 2 coming up. One is a Santa Monica Valentine's adventure, and the other one is our Cornwall Royal Manor House owned by Prince William and Princess Catherine. And this one is really amazing too. Both of them are quite extraordinary. So just email us at info@nataliepace.com, whatever you're interested in. And we're here to give you the news, information, and education that you need to be the boss of your money and to live a richer life. And all of this is possible with the life map that we all should have received in high school. So thank you so much for joining me today.
Strawberry dreams riding in, white limousines dreaming on, strawberry fields lying in, peaches and cream, chocolate